Today, I'd like to share with you the top 14 points on effectively minimizing your tax liabilities within legal boundaries. This video primarily caters to individuals earning under $400,000 per year. The reason I'm specifying this range is that if your income exceeds $400,000 annually, there are additional tax strategies available for you. Things start to get a little more intricate once you pass the $1 million threshold, and there's a multitude of gray areas to navigate. However, for today's discussion, we'll focus on insights relevant to those making under $400,000. Now, I want to be upfront with you. There's no magical solution or secret hack that will magically reduce your taxes to zero. Those privileges are typically reserved for billionaires with intricate offshore structures and an army of tax attorneys. But don't fret. I'm here to guide you through legitimate ways to minimize your tax burdens while ensuring a good night's sleep. We'll explore the art of effectively maneuvering within the legal framework and optimizing your deductions, ultimately helping you save more money. Let's get started. Number 1, commuter benefits. If your employer provides this perk, make sure to leverage it. In 2023, you have the opportunity to enjoy tax-free commuting expenses, allowing you to allocate up to $300 per month. Essentially, this translates into a $300 tax deduction every month, summing up to $3,600 per year. These benefits cover various modes of transportation, including mass transit options like trains, subways, and buses, as well as ride-sharing services such as Uber or Lyft. Additionally, it extends to parking fees for meters, garages, lots, and more. Number 2, retirement plans. Ensure that you take full advantage of the retirement plans offered by your employer, such as 401k or a 403b plan. A 401k is typically available in for-profit companies, while a 403b plan is offered to employees working for certain government entities or nonprofit organizations. By contributing to your 401k or 403b plan, you not only reduce your taxable income for the current year, but also start building your retirement savings. It's important to note that there are various retirement plans available beyond the 401k and 403b, but these two are among the most commonly known options. Number 3, health spending account, or HSA. An HSA is designed for individuals with a high deductible health plan. It provides a tax-advantaged way to save for medical expenses. By contributing to your HSA, you can lower your taxable income through a tax deduction. Here's how it works. You deposit money into your HSA, which essentially acts as a dedicated savings account for health-related expenses. When you use this money for qualified medical expenses, you do not pay taxes on it. This means you are effectively using pre-tax funds to cover your healthcare costs, which is fantastic. Furthermore, you have the option to invest the money within your HSA, and any earnings or interest generated from these investments will be tax-free. This allows your HSA to potentially grow over time, providing additional financial benefits for your healthcare needs. Number 4, flexible spending account, or FSA. An FSA is a valuable tool that enables you to pay for eligible healthcare expenses using pre-tax funds, which can provide significant savings. However, it's important to be aware of the use it or lose it rule associated with FSAs. Typically, if you have any remaining funds in your FSA at the end of the year, you may forfeit them unless your company offers a rollover option. It's essential to plan your FSA contributions carefully to align with your expected healthcare expenses throughout the year. By estimating your eligible expenses accurately, you can maximize the benefits of your FSA without losing any unused funds. Be sure to review your company's specific FSA rules and any available rollover options to make the most of this opportunity to save on healthcare costs. Number 5, dependent care FSA. With a dependent care FSA, you have the opportunity to pay for qualified childcare expenses or care for adult dependents using pre-tax funds. This provides a beneficial way to save money and reduce your taxable income. You can utilize the funds from your dependent care FSA to cover a range of expenses, including daycare, nursery expenses, preschool fees, payments to nannies or au pairs, babysitters, day camps, after-school programs, and even adult daycare facilities, among others. By using pre-tax money for these expenses, you can maximize your savings and reduce your overall tax liability. Now let's move on to exploring methods for saving money and minimizing taxes through investments. Number 6, capital losses. If you have incurred losses from cryptocurrency investments, it is essential to report them for tax purposes. Losses can be advantageous as they can be utilized as tax deductions, reducing your overall tax liability. When it comes to stocks, you will typically receive a tax form known as a 1099-B, which will account for your stock losses. Stock losses are generally difficult to overlook or miss, as they are clearly stated on this tax form. However, I want to specifically address cryptocurrency losses because, in many instances, you may not receive a year-end tax form for your crypto transactions. This often leads people to forgetting to report their crypto losses or simply being too lazy to do so. It's important to remember that by neglecting to report your crypto losses, you are essentially forfeiting money to the IRS. Don't let that happen, and make sure to report any cryptocurrency losses to maximize your tax benefits. Number 7. Long-term capital gains. When you hold on to a stock or cryptocurrency for more than 1 year before selling it, the resulting gain is classified as a long-term capital gain. Long-term capital gains enjoy more favorable tax treatment compared to short-term gains. The tax rate for long-term capital gains is typically about half of your regular tax rate. Furthermore, if your income falls below a certain threshold, you may qualify for a 0% tax rate on long-term capital gains. This means that you would pay no federal taxes on your profits, making them 100% tax-free. Taking advantage of the lower tax rates for long-term capital gains can be a strategic move to minimize your overall tax liability. Be sure to review the specific tax regulations and income thresholds applicable to your situation to make the most of this tax-saving opportunity. Number 8. Review your 1099-B tax form. The 1099-B is a year-end tax statement that provides information about your stock market activity. You receive this tax form from your brokerage account, such as Robinhood or Ameritrade, typically between late January and mid-February. You can also download the 1099-B form directly from your brokerage account's tax section on their app or website. When you receive your 1099-B, it's crucial to review it carefully to ensure there are no obvious mistakes. One common mistake that can result in paying more taxes than necessary is when certain information is blank or missing from the form. Specifically, pay attention to the cost basis information, which indicates how much you bought a stock for and how much you sold it for. If the cost basis is missing, it may appear as if you bought the stock for $0, making your proceeds look like pure profits. This can lead to mistakenly paying higher taxes on the gains. Therefore, it's essential to carefully review your 1099-B and watch out for any obvious errors or missing information, particularly regarding the cost basis. By catching and rectifying such mistakes, you can ensure that you are accurately reporting your stock market activity and avoid paying excessive rates. Number 9. Deduct margin interest. It's important not to overlook the deduction of your margin interest. Margin interest refers to the interest paid on funds borrowed to invest in securities. You can deduct this investment interest expense, and it will be listed on your 1099-B tax form. Many individuals forget to report this deduction because it is not always prominently displayed on the cover page of the tax form. However, it is essential to review your 1099-B thoroughly and locate the information related to your margin interest deduction. By deducting your margin interest, you can lower your taxable income and potentially reduce your overall tax liability. Be sure to accurately report this deduction to take advantage of the tax benefits it offers. Number 10. Gambling losses. This tip may seem random, but it can be quite useful for individuals who engage in gambling activities. If you have a substantial win at a casino, you will receive a tax form called a W-2G. It's important to note that this not only applies to million-dollar jackpots, but also to significant wins in the range of a few $1,000s. The casino is required to send a copy of your winnings to the IRS. It is crucial to report these winnings on your tax return to avoid any potential issues with the IRS. However, here's where it gets interesting. If you receive a W-2G for your gambling winnings, you can reduce the taxable amount by the amount of money you lost from gambling. This includes losses from table games, slots, sports betting, horse racing, and other gambling activities. By using your gambling losses to offset your gambling winnings, you can potentially lower your overall tax liability. Remember to keep accurate records of your gambling activities, including both winnings and losses, to support your deductions and ensure compliance with tax regulations. Number 11. Traditional IRA. In addition to the workplace retirement plans like the 401k and the 403b that we discussed earlier, there is another retirement plan called the traditional IRA. The traditional IRA is a retirement plan that you can set up outside of your workplace. Depending on your specific circumstances, you may qualify for a tax deduction for contributing money to your traditional IRA. This means that the amount you contribute to your traditional IRA can potentially reduce your taxable income, providing you with a valuable tax benefit. It's important to keep this in mind and explore whether you are eligible for a tax deduction based on your income and other factors. Consult with a financial advisor or tax professional to determine the best course of action for setting up and contributing to a traditional IRA. Taking advantage of the tax deductions available with a traditional IRA can help you save for retirement while simultaneously reducing your current tax burden. Number 12, the 529 plan. If you have plans to save for education expenses, whether it's for your child, someone else, or even yourself, consider utilizing a 529 plan. A 529 plan is a tax-advantaged saving plan specifically designed for educational purposes. It's important to note that contributions to a 529 plan do not qualify for a federal tax deduction. However, depending on the state you reside in, you may be eligible for a tax deduction on your state's income taxes. It's worth checking your state's rules and regulations regarding 529 plan contributions to determine if you qualify for any state tax benefits. Even if your state does not offer a tax deduction, there is still a significant benefit to having a 529 plan. The growth of the funds within the plan is typically tax-free, meaning you won't owe taxes on the investment gains as long as the funds are used for qualifying education expenses. Remember to explore the specific rules and benefits associated with 529 plans in your state and consult with a financial advisor or tax professional to determine the best approach for your education savings goals. Number 13, fix your W-4 payroll settings. If you consistently find yourself owing money to the IRS when you file your tax return, it's essential to address the issue to avoid potential underpayment penalties. Many individuals overlook these penalties because they are automatically added to the balance due on your tax return. To prevent this, you need to make adjustments to the amount of taxes withheld from your paycheck. This adjustment can be made by updating your W-4 form with your payroll department or adjusting your payroll settings if you have access to them. By reviewing and updating your W-4 form or payroll settings, you can ensure that the correct amount of taxes is being withheld from your paycheck throughout the year. This helps you to align your tax withholdings with your actual tax liability, reducing the likelihood of owing money at tax time and incurring underpayment penalties. If you're unsure how to make these adjustments, there are resources available to guide you through the process. Taking control of your W-4 payroll settings can help you better manage your tax obligations and avoid any surprises or penalties when it's time to file your tax return. Number 14, minimal rental use rule. Many individuals have been utilizing platforms like Airbnb to rent out their homes or properties. It's important to be aware of the minimum rental use rule, which states that if you rent out your home for 14 days or less in a year, the income you earn from that rental will be 100% tax-free. This rule provides a valuable opportunity to generate rental income without incurring any tax obligations. However, it's crucial to accurately report this rental activity to ensure compliance with tax regulations. Failure to report it properly may result in unnecessary taxes being owed. To ensure that you are correctly handling your rental income, it is advisable to consult with your accountant, as they can provide you with the necessary guidance and help you navigate the reporting requirements associated with this rule. I hope these tips have been helpful in your quest to reduce your tax burden. If this video has indeed helped you save money, I encourage you to please give it a thumbs up and subscribe to our channel for future videos.